From Tax Accounting Adelaide. This month in our update we're letting you know about the superannuation changes which are changing effective from the 1st of July 2017, so coming into the next financial year, and they were announced in the last budget which was May 2016. So this is just an intro only. I'm not going to go into all the details tonight because I don't have too much time just on this little video, but if you do think that some of these affect you, if you're one of our clients, please call and book in and we can discuss that further with you over an appointment, or if you're not a client, feel free to book in online on our website at taxaccountingadelaide.com. And also I'll give you some details of we're running a little superannuation update seminar early in this month, so I'll give you the details of that in the end. Okay, one of the major changes announced is there's going to be a 1.6 million balance limit on our superannuation funds. So that's pretty much per person. So in some cases of self-managed super funds where you've got more than one member, that can be times by up to the 4 members. Yeah, generally all of us, not many of my clients are over this, so it doesn't affect too many people, but it does affect the landscape of your goals and how you have to see super. It's obviously a good amount still to have in your super, obviously at retirement. But yeah, if you're dreaming of having more, you need to just rechange that landscape. Basically, the reason why the government has introduced this is to limit the amount of wealth you can have without being taxed much. Obviously, if you've got a $10 million self-managed super fund or superannuation when you're retiring, and that's no longer taxed at all, that's a lot of wealth that the government thinks is not being taxed. So it's made a political decision, whether that's right or wrong, to tax people with more wealth at their retirement, and they're limiting it to 1.6 million. So remembering that superannuation is taxed before you retire at 15% and after you retire at 0%. Okay, there's been some changes to concessional super contributions. So we used to be able to generally contribute 30,000 if you're aged less than 49. You can now contribute only 25,000 and get a tax deduction for that under certain circumstances at the moment. I'll tell you that that's opening up to more people in another slide, but employees can now also claim 25,000 for super contributions. So this means that whether if you're salary sacrificing to do super contributions, you may need to review if you want to continue to do that, because you can now do it directly as a super contribution and get your contribution. So it may be a little bit easier for you to just do it directly as a super contribution and claim your tax deduction, rather than doing it by salary sacrificing. There's been changes to the non-concessional cap. So the non-concessional cap means amounts you can put into your super without claiming a tax deduction for. So this is now being limited to 100,000 per year, and there's actually a lifetime limit on that as well. There's been a change to the threshold which people do pay at the moment. If you're an income earner of above 300,000 taxable income, your tax rate on superannuation increases from 15% to 30%. This is now reducing to 250. So if you are going over 250, you will have to pay an extra 15% tax on your super contributions, and their employee ones as well. There will now be a low income super tax offset. So if you are earning less than 37,000, you will pay less than 15% on your super contributions. As I mentioned before, workers can contribute to super and get a tax deduction now. So there's increased access to contribute to your super, even when you're a worker, when you're under 65 or between 65 to 74, when you're still working, and you can claim a tax deduction on that. So from the 1st of July, if you need to this is going to be a good tool for all workers, particularly if you've got no tax deductions and you've got enough money to pay your house, pay for the family and kids. You don't want to affect your take-home pay, or you've got too much cash in the bank. This is a great tax minimisation tool that you can look at. Previously, this was only available for self-employed people. The new super changes will allow catch-up concessional contributions. So, for instance, I've given an example here. If you miss your $25,000 concessional contribution, which gives you your $25,000 tax deduction by putting $25,000 into your super, if you miss it in 2018, you can then do $50,000 in 2019. So, if you need any help with your superannuation or your self-managed super fund, we are here to help you and can give you some advice and tips on what to do. Our seminar is coming up. We're having a seminar on Wednesday the 21st of March at 6 p.m. on our office. You'll see some details on our newsletter link if you want to join and be informed on some specific situations that may affect you. You may also call us for an appointment, particularly if you're a client. You can call us anytime and discuss some of the super and how that's changing for you. I'd recommend doing it in April and May because you need to look at it before the new tax year starts. And if you're not a client, you can always just go visit our website and make a booking to see us about your individual super or self-managed super fund situation on our website, taxaccountingadelaide.com. Our phone number is 088 337 4460, or as I said, book in online on our website, which is